Hi, everyone. This is Jason Barack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's derivatives expert Rob Kirby of Kirby Analytics. Thank you for joining us again, Rob.
Pleasure being with you, Jason.
Now, Rob, we've had a lot of stuff going on in the gold market as usual. The paper price doesn't seem to be doing a whole bunch, but there's always a lot going on behind the scenes. Kuz Jansen of Bullion Star, who I think does the best research, he does quality research compared to the World Gold Council, which has a lot more resources than him. Kuz is saying that in 2013, over 100% of annual global mining supply was imported by China. In 2014, even more than 100% was taken by China. And in 2015, we're on an even faster pace. Where do you think this gold is coming from then to satisfy the gold market?
In a very minor way, Jason, I don't believe the World Gold Council numbers in terms of global mine supply to begin with. I think there's a reasonable amount of undocumented gold that comes out of Africa that never makes it into the World Gold Council's figures, but that does not answer to the amount that the likes of China and India are consuming, and where that gold is coming from is from Western central bank hoards of whatever they have left. And from that, we can draw the conclusion that whatever Western central banks claim to have in their vaults, this is probably not very accurate or very trustworthy data reporting. And reasoning for that is that we know Western central banks lease gold. When gold is leased by Western central banks, it physically leaves the vault, and it's counted on the same line as gold present in the vault. So this is actually double counting. If you or I did this on our income taxes, Jason, we'd go to jail. But central banks, as a matter of fact and record, it's not a theory. As a matter of fact and record, central banks do account this way. And so gold is being siphoned off from the Western world central banks, and I also completely expect and suspect that the big ETF GLD is very likely being run as a huge slush fund.
Yeah, and I think the same thing with SLV. I talked with John Embry when I was up in Toronto in September, and he told me he doesn't know where all the silver's coming from. He thinks basically they've taken almost all the metal, if not all the metal, out of SLV to meet the demand, because I think physical silver's been in a deficit for at least a year so far.
Yes, no, I agree with that 100% as well.
My next question is, obviously we're seeing very strong demand for physical. The paper market doesn't show this, so clearly I think the demand for physical is very strong regardless of the stupid research that the World Gold Council puts out. But, we're seeing a lot of miners in a lot of financial problems. Do you think the investment banks are going to bail out the miners? What happens to the physical market if the miners start to go bankrupt or shut off the mines and put them on care and maintenance?
Well, I think the banking community very likely marches to the drum that, and the notion that miners are, especially smaller ones, or anyone that's a high cost mine that's running into financial difficulties, I don't believe this is by accident. I truly believe it's all by design. And, we're going to see consolidations, and what will end up happening is that production and reserves will be consolidated into very few hands, where they will be very susceptible and very likely scooped up in the future, whether it's the near future or the intermediate future. They'll be scooped up by let's just say status quo friendly institutions that will do the dirty work for the status quo financial elites.
Yeah, I see the writing on the wall that the bullion banks know that this is not sustainable, that the miners are in a lot of trouble, and we're seeing the bullion banks start to transition. I think J.P. Morgan has a large investment in the Shanghai Gold Exchange, and these large investment banks, whether it's Morgan Stanley or J.P. Morgan, they have very large share positions in like the Sprott Physical Silver Trust, the Sprott Physical Gold Trust. I heard that, and Ted Butler even has a theory out. He's saying that J.P. Morgan has already accumulated over 40 million ounces of silver. What's your opinion on Ted Butler's theory, how J.P. Morgan is hedging their paper derivatives with actual metal?
In all honesty, I don't know where you get the information to make such a claim. I mean, J.P. Morgan is a huge player in the metals, is certainly in the paper trade. How big and to what extent they're involved in the physical trade, I really can't speak to that. I just don't have the data. I don't know where Ted gets that data. I don't know. If he has it, good. I just don't understand where he gets it.
Okay. Well, I guess then maybe we could talk to Ted, try to get him on here in email. I think David Morgan actually said he heard from different sources of something similar, but it's not that the J.P. Morgan was buying the Silver Eagles directly from the U.S. Mint, but that they were starting to buy physical silver. So it's just
they listen. I'm not saying they aren't. They may very well be. I just don't have any supporting data. There have been times in the past, and I can honestly say I haven't lately, but there have been times in the past where I have looked high and low for information regarding big bullion banks physical accurate data regarding their physical stores, and I find it very, very difficult to find.
Yeah, I mean, there's just no one thing I've learned, Rob, since I've been studying the gold market since like 2008 is there's just not much transparency there. So the company when a company has an allocated account, they just don't really declare it. I mean, there's just so many rules changes with the gold market. I think J.P. Morgan got it, or the custodians of the SLV got it now, so the metal in the SLV can be siphoned off to cover COMEX contracts. So I mean, there's
but Jason, when your comment about allocated accounts, I personally know of situations where large investors, very, very large, sophisticated investors, had what they thought was, or had the documentation showing ownership of allocated physical bullion, and when the entity holding that bullion was presented with orders to have that allocated bullion put on the ramp and moved to a different location, they've had to literally admit that it wasn't there. And I can tell you, I know of at least one institution where a national government had to get involved to make good on a big banking institution, and the flavor of this bank is from a country that makes good cheese. And when this allocated bullion was ordered to the ramp to be moved, they were given excuses for a while, and then they were finally told that first they were told that they couldn't move it to the ramp because it was at the back of the vault, and then threats were made, and then they were finally told that it isn't there, and then a government had to get involved to make good on that physical. So and that story dates back about 4 or 5 years. So there's all kinds of pretenders out there. There are all kinds of instances where people think they have allocated bullion, may actually have documents that they believe they're in allocated bullion, but when you try to move it or try to take physical possession of it yourself, it's less than what is claimed. Let's just put it that way.
That's very interesting. That sounds similar to the story that I've heard about why the Bank of England sold their gold at the bottom of the market. How there was pressure because investment banks had sold or leased gold, and that they had gold that they had to deliver from allocated accounts, and there wasn't the gold, and the Bank of England had to cover those losses.
Yes, that would rhyme with the story that I just said. And, it's amazing how these countries that are famous for being depositories of gold and safekeeping and really not as safe as maybe they're cracked up to be.
Yeah, I mean, with the rules changes from politicians and the bank bail-ins being proposed, by these Keynesian academic economists writing white papers for the IMF and the Bank of International Settlements, Rob, we definitely live in a time where, it's very, very dangerous to trust other counterparties.
Absolutely, which is the beauty of physical precious metal. No counterparty risk. That's as long as you'd actually possess it.
So, you think if we do have a lot of bankruptcies from the miners in the next 12 months or so, and if the metals prices don't start going higher, I think we're going to have a pretty good percentage of bankruptcies in the near future. You think then that the metals price is going to have to rise?
My guess is that it will at some point. You see, my view, Jason, is that what's going on in the bullion market is investment demand is being met with paper, and physical demand has not yet overwhelmed the paper supply. And unfortunately, I think there's still an awful lot of big investment dollars that actually believe when they buy GLD they're getting exposure to physical metal. I don't believe that GLD is a reputable entity. At least in my view, I don't believe it, and for a host of reasons, which we don't even need to get into now because we could talk 45 minutes about that. But well documented over the years, many issues relating to the language in their prospectus, how the vagueness in terms of who the custodians are. There's just too many question marks, and their prospectus is just for my liking too full of holes. So, but I think there's an awful lot of hedge fund managers that still think that when they buy GLD, they've got great exposure to gold, and they view it the same as if they had bars in their own office or in their own vault. So can't help that. Those people will, in my view, will ultimately end up learning the hard way, and they will ultimately, in my view, end up finding out that when they need the gold exposure the most, thinking they have gold exposure, they'll find out that they really didn't have gold exposure at all, and they're going to find out that all they were a part of a big fraud. So that's how I think that story ends for a lot of big money.
Yeah, I've heard secondhand from Dave Cullum, who's friends with a big hedge fund manager who tried to remove about $50 million, I think, worth of physical gold in 2009 or 2010 from GLD, and they wouldn't let him remove it, and he obviously met the requirements. And then I've heard from Grant Williams, he was a precious metals portfolio manager, and he met the requirements for what is in the prospectus to remove physical gold from GLD, and the investment banks, the custodians, wouldn't let him remove it either. So I guess they're going to keep changing the rules on us, Rob, because I guess, they have the money and they could just print money out of thin air, and they have the lawyers, who are paid big bucks to mess with us. Well,
the banks are no different, Jason. If you have a lot of money in the bank, you go to get your money out of the bank and you find out that there's really a lot of restrictions on getting your money out of a bank.
Well, you not only can you not take out that much money, Rob, you can't even deposit that much money anymore without, getting suspicious eyes. Like, why are you depositing thousands of dollars here? Are you a drug dealer, or money launderer, or criminal, or something like that?
Exactly. You see, cash is becoming a very difficult, and that's by design, Jason. They want people to they want to get rid of cash, and what they want to do, Jason, is put us on digital money. And just so they can turn us on and turn us off.
That's interesting. So I guess you're not a big proponent then of Bitcoin, even though it's not controlled by the banks yet.
I don't know who can. I don't really know enough about Bitcoin I don't really understand its genesis, except I strongly suspect that the intelligence community had a lot to do with the creation of Bitcoin, and that raises flags and raises my eyebrows right away.
Okay, fair enough. Well, switching topics here to the over-the-counter derivatives, which you're an expert in. You've come on the show in the past, and you told us that the over-the-counter derivatives market, which I think is almost a quadrillion in value, could collapse at any time. Why do you think it hasn't collapsed yet?
Well, I think largely because when at least here's my view on it, Jason, is that when big American banks get in trouble with their derivatives books, I think the rule gets invoked where for national security purposes, publicly traded companies can be excused from making accurate financial reports on their true financial condition. So, if a bank like J.P. Morgan with a $75 trillion derivatives book, or Morgan Stanley with a $50 trillion derivatives book, if they're offside in their book by maybe $1 trillion or something, or a big number, like much more, maybe many times more than what their capital is, there is a law on the books that states the intelligence czar or an appointed person can grant them the waiver where they don't have to have accounting. So my question back to you is, if the institutions that you're speaking about, why haven't any of them blown up? If they don't have accounting, how would we ever know if they're not blown up?
Yeah, that's a good question. And they could also be getting backdoor bailouts. So they don't even have to disclose that. That's why we're hearing, just announcements, it seems like almost every week or two now, of new currency swap deals. So, yeah,
but these are... just to follow that up, I want to speak directly to a situation that occurred back in the 2007-2008 time frame. And if we take 2008 specifically, when Lehman collapsed, when forces from above made Merrill Lynch forced the marriage of Merrill Lynch and Bank of America, and the rumor all over the street was that they were looking for anyone who would take and wed themselves to Morgan Stanley. And I don't have any particular axe to grind with Morgan Stanley as an institution. I think they're very good investment bankers. But I mean, from the credit side, if you look at institutions just as credits, as in banks have a credit rating, all companies have credit ratings, and back in that 2008 time frame, Morgan Stanley, nobody would dare wed themselves to Morgan Stanley, because they nobody wanted to stand at the bottom and try and catch a sword like a layman, and so anyway, so they couldn't marry Morgan Stanley to anyone. But lo and behold, in that same window, in a 3-month period, Morgan Stanley grew their swap book by an astounding $8 trillion in one 3-month period. And you see, interest rate swaps are credit instruments, Jason. And credit instruments, credit instruments require that your counterparty in that kind of trade has a credit line for you. And the notion that Morgan Stanley could strap on $8 trillion worth of these credit instruments, which required their counterparties to have credit lines for them to the tune of $8 trillion in 3 months, is a leap. It's a leap, and it's such a leap. This would be the equivalent of somebody entering the long jump and jumping 180 feet. Human beings can't jump 180 feet, and Morgan Stanley does not have credit lines in the international banking arena they don't have enough counterparties with enough credit lines to do $8 trillion worth of business in that segment with anyone, unless it's with the U.S. Treasury, which goes right back to what I said. They were very likely insolvent, and the swaps that were being done with the Treasury, specifically with the Exchange Stabilization arm of the Treasury. Those trades were being brokered by the New York Federal Reserve, and this was a stealth recapitalization of, in my view, a stealth recapitalization of Morgan Stanley, because it's very likely that they were insolvent. It's very likely, and you can explain how it was very likely, because you can explain how they did $8 trillion worth of these instruments, which in my view, and I think in most accountants' view, if they understand the nature of the instruments that they put on their books, they couldn't have done it, but they did. And the only way that could have been done without public disclosure of how it happened, it would have been if their accounting function stopped, so they weren't reporting what was really going on. So anyway, my view on all this, Jason, is that with my knowledge of this, I think I could go in and explain it to a jury and get a conviction. And I know that this is what had to have been going on. And I mean, all this data, you can go back and look at the history. You can look at their book, Grow by $8 trillion, at a time when nobody wanted to have anything to do with them.
Yeah, I mean, $8 trillion, Rob, that's like half of the U.S.'s GDP right there. The U.S.'s GDP, which is overstated. The U.S. GDP is overstated. Yeah. It's $16 trillion.
And right? That was in one specific 3-month period. And you can go back and read about it and look at the data. You can see it. You just go back in the quarterly derivatives report posted on the website of the Office of the Controller of the Currency. These quarterly derivatives reports are all posted and archived there. You can go back and look at it yourself. Like, I mean, and this all occurred shortly after Morgan Stanley became a bank. So anyway, it's absolutely amazing what goes on that really can't really happen in reality, but it happens anyway. So and that's because we don't have markets anymore, Jason. What we have are interventions, and what we have is the heavy hand of the U.S. Treasury and their Exchange Stabilization Fund in engineering outcomes in all strategic markets now. The bond market is arbitrarily engineered. The metals markets are arbitrarily engineered. The equity markets are arbitrarily engineered. We don't have free markets. And this is all a very, very, very dangerously run criminal conspiracy. It's not a theory. It's a factual criminal conspiracy that's being run. And when it fails, a lot of people are going to say this is the failure of capitalism. This isn't capitalism at all. What we're experiencing and what we're witnessing is nothing other than central planning at its worst, and at its most devious worst. And what it will be, in fact, even though it will be misrepresented, it will be told it's a failure of capitalism, but it will truly be central planning's finest hour.
Yeah, Rob, I mean, capitalism involves bankruptcies, and they're not allowing any bankruptcies. And if there was a free market, these banks would have never gotten as big as they have. It's only been because of government protection, these central banking cartels, right, which are backstopped by U.S. taxpayer, their ability to create unlimited amounts of money. This wouldn't happen in a free market. The free market would have checked these smaller banks when they were allowed to create money. There would have been a bank run. The banks would have gone bankrupt. The assets would have been bought by a more prudent person. None of these things are happening. And yet, like you said, I think the progressives assert the viewpoint that the capitalism is going to get blamed, but the Federal Reserve is a banking cartel. It's not a part of the free market.
No, central banking, Jason, is the central plank of the Communist Manifesto. Central banking is not of capitalism. Central banking is the antithesis of capitalism. Central banking has everything to do with central planning and communism. And, that speaks very loudly to where we are and what's become of us.
Yeah, I agree. I mean, if the free market, if the market can't decide interest rates for, different credit worthiness and things like that and coordinate the interest rates, then it's going to send reverberations and misallocate capital throughout the economy. And we have trillions in misallocated capital, whether that's trillions misallocated in China or trillions misallocated in Japan or trillions misallocated in Europe or trillions misallocated to the developing world or trillions misallocated to, derivatives bets that these banks have made gone bad. That that money would have been better served putting back in people's pockets, in the small businessman or the entrepreneur. So on Main Street, they could actually reinvest in their business and create jobs and make the real economy better.
Sure. Winners and losers, Jason, are being arbitrarily selected. There is nothing to do with there. You see, none of our markets, Jason, are allowed to clear. There's been the metals market cannot clear. The bond market cannot clear. The equity markets cannot clear. Nobody really knows what value is anymore, and that stems from engineering interest rates to zero. And when you make capital free, capital gets allocated in ways that you just never know.
Yeah, it's becoming a rigged casino, Rob, like you said, where, bonds go up, stocks go up, real estate is allowed up, and, the metals prices are capped. It just seems that way where, those markets, if you just stick with those predictions and they're going to try to fight these things through, they're going to try to keep these asset markets going in the directions that I just mentioned.
Well, I'll just tell you, Jason, the sad thing that, humanity one day will look back and people should be very ashamed. People should be very, very ashamed of themselves. People who purport to be practitioners of economics, trying to use economic fundamentals to justify the goings on in many of these markets today. And because, or lack of markets, as I would say, but to hear people try and explain metals prices in fundamental terms, or fundamentally explain why metals prices are where they are, or fundamentally explain why interest rates are where they are, without mentioning the word derivatives. And anybody who I seem to read that talks about interest rates, none of them, not one of them will try to have an intelligent discussion about the derivatives market and the size of it and what the implications are for interest rates and demand for U.S. government securities. And you see, because you can't have an intelligent discussion about interest rates without talking about that. You open this interview by talking about derivatives being roughly a quadrillion in size, depending on who you talk to or whose numbers you use. But be aware that 80%, at least 80% of all derivatives outstanding are interest rate derivatives. So that means if the derivatives market is a quadrillion, there's 800 trillion in interest rate derivatives alone. How can you have an intelligent discussion about interest rates if you don't mention it?
Rob, you can't, but I'm not even sure, Rob. I've talked with a good amount of Wall Street people and regular Keynesians. I've tried to enlighten them. They think I'm crazy or stupid. But I don't even think most of them know what an interest rate swap is. I've actually point blank asked a few of them if they know what an interest rate swap is, and they changed the topic. So I don't think they even know what one is, or currency swap for that matter.
So they don't want to discuss it. And yet they will try to, or many of them will try to explain interest rates in fundamental terms. It's so ridiculous. It's like trying to explain the game of hockey, but not mention that they use sticks and pucks. Like you can't. It's how can you explain the game? How can you explain what's going on if you're not talking or discussing the biggest element of it?
Yeah, I agree. I don't even think I've heard financial repression mentioned once on CNBS or Bloomberg, or BNN. I don't think I've ever heard on these major business. They're supposed to understand markets well, but I don't think I've heard financial repression, which is manipulating interest rates. And, Japan's doing it, Europe's doing it, the UK's doing it, the United States is doing it. Everyone's trying to manipulate interest rates with these interest rate swaps lower and lower. I don't think I've ever heard it mentioned once in the mainstream.
No, they don't want to talk about it.
My next question, Rob, has to do with Ron Paul's partial audit of the Federal Reserve. I think in 2009 he was able to get a one-time partial audit of the Fed, and they gave out $16 trillion in bailout money. But in my opinion, I think there was more given out. Do you think most of that money was meant to cover derivatives losses?
The talk about the bailout monies to begin with, we don't. You're correct. I think, in making the statement that we don't know exactly how much was given out. Yes, and we don't know exactly for sure who it was all given to. But I'll just tell you that the people that make claims that $16 trillion was given out, the way they count that is incorrect. Because, for instance, I'll make this. There was one U.S. senator who sort of made a bit of a name for himself when he published a piece about how much he had done some work and said how much was given out by the Fed, and it was an astronomical number. But his tabulation in terms of when he was adding up the numbers, he was counting. He was double and triple and quadruple counting, and the way that he was doing that was to make a for instance. If the Fed had lent $300 million overnight money to Citibank from Monday till Tuesday, and then if they rolled that loan from Tuesday till Wednesday, and then rolled that loan again from Wednesday till Thursday, said Politico, his name, I'm sorry, I can't remember his name, said Politico said that loan of $300 million for over 3 nights, like for 3 days, he counted that as a $900 million. Like, so he would triple count. So what I'm saying is, if the same loan was being made on an ongoing basis to an institution, and if it was rolled day after day after day after day, he was just adding the numbers up every day and saying this much. One loan of $300 million rolled for 3 days is not a $900 million loan. It's $300 million. And then if it gets repaid at the end of 3 days, then it's a zero-sum gain. $300 million was lent overnight for 3 days, and it was paid back. But this guy was using some sort of Chinese accounting where he was stacking these amounts and saying that this was all money that the Fed had lent out, and it wasn't, not that much. But that being said, why the Fed wasn't more transparent and more upfront about what they were really doing, I don't know. And it makes me wonder, and it makes me, you see, the accounting is all opaque. And the reason it's opaque is because if we had real accounting, we would be uncovering which institutions are really insolvent and which ones are really okay. So what they do is they muddy the water, and they make sure they keep it real muddy and real dark, and that way nobody knows what anyone's doing. And basically what it amounts to is you keep the water so muddy and so dark that you can just pick and choose who the survivors are going to be, and then you can just build a story as to what happened.
Yeah, the banks, they just seem to want to consolidate the banks further. I mean, if you're a hardworking small community banker and you're not doing fractional reserve lending and you're trying to do the right thing, the game is stacked against you. There's no way that you can compete with these big banks, who are getting all this easy money at the Fed. There's just, if you're an honest, hardworking banker at a small bank, there's no way you could do it. The big banks, they just have too much backing by the government and the Fed.
Yeah, no, you just become a snack. You become an hors d'oeuvre. You become an hors d'oeuvre for a much bigger institution that needs to have some business that they can point to and say that, look, we do some banking that's clean, and it's not any business that we grew on our own. It's just we just had our friends in Washington say that this institution was in bad trouble, and we took it over. Bingo.
We're seeing an enormous consolidation among the small and medium-sized bankers because they can't deal with all these extra rules and regulations. So all these extra bailouts and rules and regulations in the banking sector, they're forcing even more risk of collapse. They're forcing more consolidation and stuff like that. It's just setting up for a larger and larger collapse sometime down the road.
Yes. And Jason, what we were speaking about just a minute ago with regards to the, nobody wants to talk about the derivatives when they talk about interest rates. But, that's like talking about basketball, but there's no ball. And, and just like they don't want to talk about the derivatives when they talk interest rates, have you come across yet one notable economist on Wall Street or in the mainstream at all that wants to debate John Williams on his work regarding government fudging of data? You see, nobody from any of the big banks, no analysts from the big banks want to talk about how the inflation data is rigged, how the unemployment data is rigged, and John Williams is an extremely credible guy, does extremely credible work, and he shows us, for instance, with the unemployment rate, which is currently officially reported in the 6.5 or 6.6 or 7% range. And he shows us that if you measured unemployment the same way it was measured in 1980, it would be over 20%. But you see, we can't have it being reported at 20%, over 20%, because that would mean we're in a depression. And that wouldn't go with the government lie that we're in a recovery and everything's getting better.
Yeah, and there's
if John Williams is wrong, why won't any respectable analyst on Wall Street or in the mainstream debate him publicly and show how he's wrong? They will. You know why? It's the third rail. They won't touch it.
Yeah, if they bring him on their program, it gives him credibility. I think he used to go on all the time, but I think they stopped bringing him on because they said he was too negative all the time. Yeah. Even though I think, like, off the record, like when I remember watching interviews with him, and he said he would have discussions with bankers before recording started, and they would agree with what he said, and then he'd go on there and just lie that everything was doing well.
There you go.
Well, my next question for you, Rob, has to do with why the United Kingdom, Israel, and other countries that used to be allies with the U.S. and were lapdogs and would do almost anything the U.S. government said, whether that's buy treasuries or support this military conflict or anything like that, why they're rapidly joining the Asian Infrastructure Bank right now.
Well, I'm going to answer your question with a question, Jason. When it rains, why do you put up an umbrella?
Because you don't want to get wet.
There you go. And that's your answer. They don't want to get wet.
So they can see the writing on the wall. Then I guess they could see that I guess they're agreeing with the Bank of International Settlement warnings, the IMF warnings, that this current global financial system it's not sustainable. It's dying, I guess.
But Jason, all these countries are just like you and me. We've been saying that something bad is coming down the pipe. And everyone, the mainstream is critical of us, saying, "Oh, you've been saying that forever." Well, these guys know it's going to rain too. They don't know what day it's going to rain, but they know it's coming, and that's why they're all putting their umbrellas up.
Yeah, they're hedging their bets. I mean, they don't know what the next system. I'm not sure they know what the next system is going to be, because obviously the IMF wants the special drawing right, and China even seems kind of interested in, at least for a little while, going along with the SDR. I think they want the RMB moved into the SDR right by the end of the year.
Well, they know something different's coming, and they want to be a part of it, and and most of them, I'm sure, can't tell you exactly what day it's coming, but they know it's a coming. And it's the same thing, really, Jason. Speaking about the advocacy of physical precious metal for all these years, there's going to come a day when, if you don't own it, you're going to be in big trouble. And I don't know what day that is yet. And I just inherently believe that with every day we're getting a day closer. And one day something will break. There's certainly enough things out there now in the financial edifice that are under stress and where something could break any day. But that doesn't mean it will break tomorrow. But with the amount of stress that there is and the continuing ramping up of stress on the system, I think it's inevitable that something does break. And when it breaks, it's probably going to be too late to get positioned the way you wish you were after, it breaks. It's the old saying, Jason, once your house is on fire, you cannot buy fire insurance. You have to buy your fire insurance before the fire starts. Once the fire starts, it's too late. And so, metaphorically, we're just living in an environment where a lot of people are playing with matches in the ammo hut, and it's good.
Yeah,
It's good to have insurance.
Yeah, and physical gold is portfolio insurance, and so is physical silver. I mean, it's not really an investment; it's just for wealth preservation and insurance first. I mean, the people who are buying it to make paper capital gains on higher paper prices, that's not really the initial reason that they should be buying the actual metal for. But I think
Jason, most people who understand gold don't really trade it. Mm-hmm. They buy it and they own it.
Yeah, and the stock market keeps going up. People say, "Oh, their economy's doing." The Wall Street, the mainstream people on Wall Street, "Oh, the economy's doing well. Look at the stock market." But the stock market, look at what happened in the Weimar Republic or Zimbabwe or Argentina when the currencies in these countries was falling like crazy. Their stock market was going up. So
right.
these asset prices are pricing in rapidly devaluing fiat currencies globally, in my opinion.
Yeah, in my opinion too, but a lot of people will make the argument back to you. Then why isn't the price of gold going up? And so there again we're back into the it's for the same reason, Jason, that if I hold your head underwater, you have trouble breathing, and people can say, well, then why wouldn't you just put your head up over the water? Well, if you could, you would. But if someone's holding your head underwater, it's very difficult to do that.
Yeah, I think, if you look at the fundamentals of the gold market and how much metal is being moved from west to east, I mean, it's not going to last much longer, because if the metals price doesn't go up, the miners are going to go bankrupt, and the west is going to run out of metal to sell to the east, and then something's going to have to change in the market, or there's going to be no market at all.
Well, I would argue there really isn't a market now, but but you are correct in saying there will come a point in time when the West will exhaust its ability to ship gold east, because once the vault's empty, you can't ship more physical east.
Yep, and especially with the miners too, if they can't produce any metal either. And I think this copper price falling a lot, a lot of gold and silver mine production is byproduct of copper mines. And with the copper price falling, those copper miners were hedged. When those hedges come off, we're going to see copper miners go bankrupt and copper production shut down. Then we're going to see the gold and silver production shut down too.
Very likely that happens to some degree at least, yes.
Well, my last question, Rob, we were talking about this before we started recording. It's just a philosophical question. It's about debt and fiat money. Do you think they cause immense moral decay then in a society?
Oh, absolutely they do. I mean, as I said to you earlier before we did record, I think it's a criminal act. I think it's a criminal act to lend somebody $150,000 to get an education, except for some very, very, very narrow, rare specialty trainings. But for instance, for a general arts degree, to lend someone $150,000 to get a general arts degree for 4 years and a piece of paper saying that they accomplished that, I think that's a criminal act. And I also believe it's a criminal act for the perpetrators to be lending countries the likes of Greece $350 billion when they have a $242 billion economy. The Greece GDP is $242 billion. What are they doing with $350 billion in debt? I mean, and a lot of people could say, well, they shouldn't have borrowed that much. Well, you know what? Lending money to somebody that they can't repay is just as criminal as the person who takes it to give it to them. And I think I said to you, if you're in the water swimming, Jason, if I throw you an engine block from a car and tell you to swim 3 laps, I'm really throwing you to your death, because I know that'll kill you. So, and giving somebody more money than they could ever afford to repay you, all it does to the person is it causes them to behave and do things that they otherwise wouldn't do. And so, like, when you give people way more debt than they can handle, and they could ever possibly repay, what does that do to the fabric of society? What does that do to a person's inclination to steal, to take undue risk, to do silly things, to commit crimes, to do it? And the bankers and the people that extend this have to wear some of that on their sleeves, because they have no right doing this. Because what it does is it promotes a breakdown in society. It promotes promiscuity. It promotes evil, and it promotes bad things. It's sort of like if you have a very young kid or an infant, it's like putting scotch in his milk. And anybody who would do that to a kid, they deserve to be in jail. And anybody who would lend somebody way more money than they could ever repay, they're just as guilty as the person taking it. That's my view.
Yeah, it seems like intentional serfdom, and it's just demoralizing being in that much debt, and then you think that you're going to get a good, high-paying full-time job because you worked hard and got that degree. And then you start off at the bottom of the ladder where you would have probably gotten the same job if you hadn't gone to college and gotten the degree and taken on all that debt anyway. So it's just very demoralizing. I think eventually in the next 10, 15, 20 years, the educational system is going to have to drastically change, or it's going to completely, get removed. The tuition price hikes are just insane, Rob. I think they're 15-20% per year. They double every 5 to 8 years. It's just insane right now.
Yeah, but remember, Jason, there is no inflation.
Yeah. There's no inflation. There's no shrinkflation in food and the portion size. The bag of rice I bought, now half of it or more is with air. And even though the price stays the same at the grocery store, the amount of ounces in the bag is like half. So it's.
But there's no inflation.
Well, I think that's the name of the game, Rob. I think they have to stagflate and lie. So they have to keep the asset prices up, and they have to keep pumping debt into the system. We're seeing, we're seeing student loan debt. We're seeing subprime auto loan debt here in the United States. People who, they don't have any cash flow or any collateral to a large extent, and they could just sign their name on a paper, and they're getting $20,000 or $30,000 car loans that the car dealership knows they're going to repossess it in a couple months.
Sure, but you can manage to just squeak by as long as you can finance that new car at zero.
Well, it's sending really perverse effects and reverberations throughout society that, it's okay to take on this much debt. I mean, normally in the past, you only took on debt if you had the cash flow or the assets to support it. But that's just not happening right now. The prudent conventional borrowing and lending that used to occur, like the bankers used to make sure someone had the cash flow and the collateral, and now that's not happening.
No, all those dirty stains are all hidden with zero interest rates.
Yeah, I agree, and I think they're going to try to stagflate and lie and create financial repression and keep the asset bubbles going, or start new ones, or reinflate old ones as long as they can, as long as people don't really understand what's really happening. And unfortunately, Rob, I think most Americans don't fully understand what's happening right now. They think they want to believe the government numbers, they want to be optimistic that the economy is recovering, but yet they're millennials or Generation Xers, and they graduate college and they have an enormous amount of debt, and they're working 2 or 3 part-time jobs just to, pay their rent or put food on the table, and they don't have any money for savings, and they can barely get by.
Yep, all stoned on cheap debt.
Okay, great. Well, Rob, please tell our listeners more about Kirby Analytics and where they can find your work.
I'm on the web at kirbyanalytics.com.
Okay, great. Well, thanks again for your time, Rob. I really enjoyed the discussion, and hopefully we can have you back on again in a couple months.
Look forward to it.